Hello everybody, welcome back to another Market Dash video, and today in this video, I'm going to be going over 3 of the most undervalued big tech stocks on the market right now, and it's really hard to find good valued stocks, especially big tech companies, when the market's at all-time highs. However, I still think that there are these 3 big tech companies. I think these are still very undervalued, and I still think, even though, like I said, we're at all-time highs, I still think these are perfect companies to be buying and could make huge returns in the future. So with that being said, let's get into these 3 big tech companies that I think are buys today. The first big tech company that I think is very undervalued and I think could make huge returns is going to be Google. I think Google is one of the best big tech companies to buy today, and I think this is the best one. Me personally, I have most of my portfolio is mainly in Google, so my biggest position is Google. I think Google is on pace to become one of the best AI companies in the world. I think that Google has a very good outlook. I think AI is actually going to help Google in the future become great compared to OpenAI. I think that they're going to be in the market against OpenAI, and I actually do believe Google Gemini might actually beat OpenAI in the AI race, and I think that's why Google is such an undervalued stock right now because of this. Also, recently a judge ruled that they wouldn't have to be selling off Google Chrome, so that is big news for Google stock. So like I was saying here, with Google is actually the best performing big tech company this year to date. So take a look here, Google's up a whopping 33% almost year to date. This is the best performing company, and you may be wondering, why would you be buying a company near all-time highs after it's gone up so much? I just think that this company is worth so much money and that they deserve this run up in stock, and even today I still think it's a pretty cheap price. As we can see here with the PE ratio, the PE ratio is at 26.43, and taking a look at the PE ratio for Google, as we can see in the past 5 years, it's still trading at a pretty decent valuation, although it's not at very low areas. As we can see, it's actually trading about average, so I still think that this company has a lot of room to grow, and trading near its average PE ratio I think is a very good sign to own this company. As we can see, the median at 24, and as we can see, the median at 24, right now at a 26 PE ratio, I still think that this is a good valuation for Google, even though all these other metrics are a bit higher than the median. As we can see, the price to book is a bit high here. I still think that this is still a very good time to be buying here, and the reason for that is just because of the future potential with Google. I still think that this looks very good for Google. Once again, even though the valuation looks a bit high, I think AI is actually going to help Google in the future, and with the lifted weight off their shoulders about the potential for having to sell Google Chrome and all the potential monopolistic regulations had against them pretty much going away, this has really sent the stock soaring and really helped investor sentiment. So with that being said, if we scroll up here, let's look at the SWOT analysis that gives us the strengths, weaknesses, opportunities, and threats for Google. Some strengths have to do with the AI leadership and innovation. Alphabet, like I said, maintains a leading position in AI development with its most advanced AI model yet with Gemini 2.5. Also, the cloud computing dominance has really been helping the growth of Google, growing at nearly 30% year over year with their Google Cloud. Also, diversified revenue streams. Alphabet's a pretty diversified company. Even though most people just think of it as Google search, they actually do get other revenue from YouTube ads or Google Cloud or even other bets. Even though they're not making money off of Waymo, they could potentially start to make a good amount off Waymo. If you don't know what Waymo is, it's a self-driving vehicle company. Also, the strong financial position here, the company generated $19 billion in free cash flow, so that's good, and a very strong moat with this company. But taking a look at the weaknesses, we have advertising revenue dependency. 75% of the revenue came from advertising revenue, so that could be worrying about the cyclicality of the business, because as a company is more dependent on this revenue, it's going to be harder for them in the future, especially if a recession happens, to grow, because a lot of advertisers will cut spending. Now, looking at this also, they're spending a lot on CapEx. This could be looked at as a negative, but at the same time, this could really help them in the future with the return on investment. So this could really help them or really hurt them in the future. So it could be a weakness, could be actually a strength. Also, regulation with this company, like I said, could be an issue. So with that being said, if we want to take a look at the intrinsic value calculator here with market-io, we do see that it is a bit overvalued today with an intrinsic value at $216. Even though this does show an overvaluation of Google, I still think that this could be worth it, even though it's overvalued technically. I still think that Google is such a great company, you should be willing to pay a premium. And with the institutional sentiment, 58% are bullish, 42% are bearish. And then taking a look at the average estimate and taking a look at the Wall Street analysts, actually, the average is right at what it is today. So they really aren't bullish on Google, but I kind of see that as a positive for Google. When people are kind of fearful and worried about a company, this company could actually come out of nowhere and do really good, especially with this upcoming earnings coming up. So with that being said, let's get to the next company. Taking a look at the next stock we have here, we have Meta as the next big tech company to take a look at. I believe Meta is in for very good growth in the future. I think analysts are underestimating their growth rates. They were growing at over 20% over the past 2 years. So this company has been growing insanely rapidly with their advertising revenue. Also with Metaverse, if they can start to get profitable, I think this company is insanely undervalued at today's price. So if we go over to Meta here, if we take a look at the year-to-date performance, up 24.45%. And I also do own Meta, 24.45% increase. This is like, I think, the third best big tech company so far this year with the Mag 7. So this is also a very good performer. And if we take a look at the past 5 years, we can see rapid gains from this company. So with that being said, you might think of this seeing, oh, look, the company was at $80 back in 2022. However, it's all the way up to $737. Why would I want to buy this company? However, you got to get rid of that anchoring bias, it's called. So in the stock market, you can have such thing as anchoring bias. When taking a look at the past, you can see, oh, we could have bought the stock at such a cheaper price. However, you have to realize the valuation of the company, and I truly think this valuation is still worth it. As we can see here, the PE ratio at 25.79. If we go scroll down here, take a look at the valuations. As we can see, the PE ratio is still trading at a pretty decent area, even though back in 2022, look at how cheap of a PE ratio they were trading at. So right now, it's trading at its median over the past 5 years. So that looks pretty good, and the price to book is also a bit high. So some of these metrics are a bit higher than median, but they have been growing a lot faster. So keep that in mind. They're growing at 20% over the past 2 years. So they're still growing very fast, and I believe this company is looking very good for the growth rates. Taking a look at the intrinsic value calculations here, we get an intrinsic value of about $691, so it's right near its intrinsic valuation. I think Meta is a very great company, and you should be taking a look at Meta. I think Meta is at a pretty reasonable valuation, especially if they can continue to grow at almost 20% growth. This would be a very good buy today. So with that being said, let's also take a look at the SWOT analysis. The strengths are the AI leadership. They're spending a lot of money on AI and trying to be the leader in AI, so that is potentially good for the future. They're very efficient, have good margins. Their growth rates are very good. Also, diversified ecosystem with a bunch of different platforms. 3.8 billion plus monthly active users, so that's very good. And then taking a look at the weaknesses though, Reality Labs is a financial drain. They're spending a lot of money on Reality Labs, which is for the metaverse. So they're spending a lot of money and they're unprofitable. So that is a big concern because we need to see them start to be profitable with that. Also some regulatory risks, and the CapEx spending they're doing this year for AI infrastructure is pretty crazy. Near 70 billion, almost like Google, a little less. But Meta doesn't make as much as Google, so that could be a concern. Also, AI competition. So with that being said, there's definitely some weaknesses, but I think the strengths outweigh the weaknesses for Meta, and that's why I think Meta is the second most undervalued big tech stock. And for the final undervalued big tech stock we should be looking at, I think Amazon is another great company to be looking at because if we go over to Market Dash, let's go ahead and look up Amazon here. Let's look up Amazon as we can see right here, and let's look at Amazon. Year to date, the company's actually down 1%. So this company is the worst performing big tech stock, it's actually negative. When the market's up almost 20%, 15 or so percent this year. So the Nasdaq's up 20%, S&P 500's up nearly 15%, while Amazon is a big underperformer in the market. And taking a look at the profitability here, let's take a look at the financials actually. Let's go to the PE ratio here. Let's look at the PE chart. And if we take a look at the valuation, this is actually one of the cheapest valuations for Amazon in a long time. The median at 58, the cheapest valuation it actually has ever been, besides during this time, even though that was negative. They actually had negative net income back in 2022. But right now, it's at the cheapest PE ratio. The price to book, let's see, is also at one of its cheapest. So they're trading at very cheap valuations. And I think this is why this company could be a very good company to buy today. And taking a look at the intrinsic valuation, we have an intrinsic value for Amazon at $262. So it's undervalued by almost 20% with these valuation calculations. So I think Amazon could be a huge buy. And even looking at the institutional sentiment, this is larger than both Meta and Google, with 63% bullish for Amazon. So this looks very good for Amazon. Also, Wall Street analysts have 9 of them are buys at an average price of $258. This looks very good for Amazon. As we can see, the strengths is the AWS dominance. And if you haven't heard, this week on Monday, AWS actually went down and the stock was up. So that's pretty interesting. But I think it made people realize how much AWS runs the world. I think it's like 33% of cloud uses AWS. So a bunch of companies use AWS and they're just integrated into the internet like crazy. They're also pretty efficient in their margins, especially for this company with their e-commerce business. Their main place that they make money is AWS. Strong financial position, pretty strong financial position, global e-commerce resilience, and advertising momentum. I want to take a quick look at the opportunities here. AI and robotics innovation is where I think this could be huge for Amazon. If they start to make their own robots, just think about the profit margins, how efficient that will get. Compared to a normal employee, you have to pay them a yearly salary. However, with a robot, all you have to pay is the upfront costs and then some services. So if they start to make efficient robots, then even if it's not the whole company run by robots, which highly doubt it, but if some of those positions are taken by robots, their profit margins are going to really increase. But take a look at the weaknesses. Weak Q1 2025 guidance. Also, they had some capacity constraints and slowing AWS growth. So it is slowing in growth. However, I think the way that Amazon will start to reaccelerate growth will be from robotics, and increase in profit margin will really help. Thank you all for watching this video on 3 of the most undervalued big tech stocks today that I think could be buys. So thank you guys for watching this video. If you want to go, please subscribe. And also, if you want to get more news and market data, go over to Market Dash and sign up for the email at marketdash.io. So thank you guys and see you.